Ever wondered how to calculate a stock's P/E ratio and its significance in your investment journey? Let's delve deeper. The price to earnings, often abbreviated as P/E ratio, plays a pivotal role in the complex world of the stock market and investing. This financial metric acts much like the pulse of a stock, providing us with a measure of the stock's vitality in the volatile marketplace. The P/E ratio is essentially the comparison of a stock's market valuation to its earnings. Picture yourself in a marketplace. The price you shell out for an apple isn't just for the apple alone. It's a value that factors in the apple's quality, its taste, and the demand-supply dynamics, indicating how much everyone else is willing to shell out for it. Similarly, the P/E ratio works. It provides a metric of how much investors are willing to pay for each dollar of a company's earnings, which is a key aspect of stock market investing. In simple terms, the P/E ratio provides a snapshot of the market sentiment, revealing what the market is willing to pay for a company's earnings. So, what's the process to determine a stock's P/E ratio? Let's dissect it. The P/E ratio, also known as the price-to-earnings ratio, is a financial metric derived from the stock's market value and its earnings per share, also referred to as EPS. The formula for calculating this ratio is simple. Divide the market value per share by the earnings per share. The market value per share signifies the current price at which the stock is trading in the open stock market, or the cost to acquire one of the company at present. This value sees fluctuation throughout the trading day due to the constant buying and selling transactions in the stock market. Conversely, the earnings per share, or EPS, is a profitability indicator, computed by dividing the company's net income by the number of outstanding shares. This metric provides insight into the profit garnered per share during a specific time frame, usually a fiscal year. So, why are these two elements essential? The market value per share gauges the current worth of the company according to the market. This worth is influenced by several factors, such as the company's potential for future growth, its financial health, the general economic conditions, and the sentiment of investors. In contrast, the earnings per share offers a glimpse into the company's historical performance, indicating profitability. High EPS signifies a profitable and fiscally healthy company. The resulting figure from dividing the market value per share by the earnings per share gives us the P/E ratio. This ratio is a measure of the company's valuation relative to its earnings. Put simply, reflects the amount investors are ready to pay for each dollar of the company's earnings. A high P/E ratio can suggest an overpriced stock or expectations of high future growth. Conversely, a low P/E ratio could suggest an undervalued stock or pessimistic future growth prospects. In its core, the P/E ratio reveals what you, as an investor, are spending for each dollar of a company's earnings. But why should an investor prioritize the P/E ratio? Let's delve into that. The P/E ratio is a formidable instrument in every investor's portfolio, acting as an invaluable guide through the labyrinth of stock valuation. It's akin to a compass, steering you through the comprehensive sea of stocks to assist in enriched decision-making. This is how it operates. When the P/E ratio is elevated, it could suggest that the stock is overpriced. Thus, investor sentiment might be that you're shelling out more than you ought to for the company's earnings. Conversely, a diminished P/E ratio might imply that the stock is undervalued, thus potentially introducing a golden buying opportunity. However, it's crucial to remember, its efficiency is heightened when utilized in synergy with other financial metrics. Furthermore, the P/E ratio proves to be a tremendous mechanism for juxtaposing companies within identical industries. It aids in deciphering which companies are reasonably priced, granting you an advantageous edge in making investment verdicts. The P/E ratio acts as a veracity check, echoing the importance of contemplating the price you're paying for a stock. You might be wondering, what constitutes a favorable P/E ratio versus unfavorable one? Let's dissect this concept. A high P/E ratio could be an indicator of overvaluation, as it sends a signal that a stock's price is hefty compared to earnings. It might imply that investors are shelling out more for each slice of net income, which raises a red flag that the stock may not be a sensible investment. To simplify, it's akin to visiting a luxury boutique and shelling out a considerable amount for a couture suit, while a similar quality apparel could be acquired for less. On the contrary, a low PE ratio could be a sign of undervaluation, suggesting that the stock's price is modest relative to earnings. In layman's terms, this could be a bargain. It's like discovering that same couture suit at discounted rate. However, interpreting PE ratios isn't as straightforward as labeling high ratios as unfavorable and low ones as favorable. An inflated PE ratio could also reflect investors' anticipation of substantial earnings growth in the future. Likewise, a diminished PE ratio doesn't instantly qualify a stock as a savvy investment. It could also be an indication of lackluster earnings growth or even declining earnings. Therefore, it's vital not to hinge your investment decisions purely on PE ratios. They are merely a fragment of the broader equation. You should also factor in other elements and metrics such as the company's growth potential, the industry it is part of, its financial stability, and prevailing market conditions. Just as purchasing a suit isn't simply about the price tag, but also involves factors like brand, fabric, fit, and occasion, investing requires a comprehensive approach. While a reduced PE ratio may speak of an undervalued stock, a broader perspective is pivotal. Constantly bear in mind, meticulous research is the cornerstone of informed and successful investment decisions. Diving deeper into the realm of PE ratios, what highlights should we commit to memory? Let's rewind a little. The price to earnings, or PE ratio, is an investment tool that serves as a critical fundamental analysis metric for investors, used for assessing the market valuation of a company against its earnings. It's a product of a simple calculation: the market value per share divided by the earnings per share, in this vital figure known as the PE ratio. The significance of the PE ratio within the sphere of investment tools is its capacity to present a quick snapshot of a company's valuation. An escalated PE ratio could mean an overvalued stock or high growth predictions by investors, while a lower PE ratio could signify the opposite, an undervalued stock or diminished growth expectations. Yet an essential point to underline is that the PE ratio is merely a component of an investor's toolbox. It's a launchpad, not a conclusive verdict. Other considerations, including growth metrics, market conditions, industry comparison benchmarks, should also be factored in. Remember, a shrewd investor operates with an array of investment tools and metrics, with the PE ratio being only a fraction of the larger investment puzzle.